You know, if you watch a master pickpocket at work, the success of the theft relies entirely on misdirection.
Oh, absolutely.
Right, like they bump your shoulder or they point at something shocking across the street, and your brain naturally just follows that sudden movement.
Yeah, you can't help it.
Exactly. And while your attention is completely captivated, their other hand is quietly slipping your wallet right out of your pocket.
It's just a flawless optical illusion.
It really is. You only see exactly what they want you to see. So welcome back to another deep dive, because today we are looking at a financial optical illusion of truly staggering, global proportions.
Yeah, this one is massive.
We are unpacking a highly analytical, just incredibly dense strategy memo. It's dated May 13th, 2026.
Fresh off the desk.
Right. It comes from an institutional desk penned by an analyst known as Sovereign Dispatcher. And the mission for you and me today is to figure out why the current record-high stock markets and that relentless AI boom, why all of that might actually be the pickpocket's misdirection.
The distraction, basically.
Exactly. We're going to explore why those booming numbers might be hiding a massive structural crack in global economies. Specifically, when you look at global oil reserves and emerging market debt.
Yeah, and the dominant narrative right now, the one driving nearly every headline you scroll past on your phone, is just this profound sigh of relief.
Oh, yeah. Everyone is celebrating.
Right. The stock market is setting fresh record highs, the broader indices are surging, and, crucial geopolitical tensions in the Middle East seem to be easing.
They really do.
But this dispatch argues that the entire market is fundamentally misreading the situation. Investors are throwing this massive parade to celebrate the survival of a geopolitical shock.
But they're ignoring the cost.
Exactly.
Yeah.
They are completely ignoring the fact that the economic shock absorbers that kept the system intact are now entirely destroyed.
Okay, let's unpack this,
Yeah.
because the core tension here is just wild.
It really is.
Everyone is cheering because oil prices are dropping. But this memo argues that the underlying arithmetic tells a deeply, deeply unsettling story.
The math does not lie.
It doesn't. So let's start with the most basic economic fuel we have, which is oil. The headlines are celebrating that WTI crude, the benchmark for U.S. oil prices, has fallen from a terrifying $112 a barrel down to $95.
Which feels like a huge win.
Right. And that drop is mostly driven by whispers from a Pakistani diplomatic source about a potential peace deal. Now, on the surface, falling oil prices sound like an absolute victory for the global economy.
Oh, yeah.
So why is our source material claiming that celebrating $95 oil is answering the wrong question?
Well, right at the center of that misconception is a fundamental misunderstanding of how global energy security actually functions under stress.
Okay, how so?
To see the reality, we have to look at the actions of the International Energy Agency, right, the IEA, in response to the recent closure of the Strait of Hormuz.
Which is one of the world's most critical oil choke points.
Exactly. When that closed, the IEA executed a synchronized multi-nation emergency stock release.
And this was a big deal.
It's huge. 32 countries coordinated to release 400 million barrels of oil from their strategic national reserves.
Which, just hearing it out loud sounds like an astronomically huge number. 400 million barrels.
It sounds infinite.
Yeah. The memo points out that is the largest emergency release on record. It's like more than twice the amount of oil deployed during the 2022 Russia-Ukraine conflict.
Right.
It sounds like a massive firewall against disaster.
It does sound like a massive firewall until you actually do the forensic accounting, which is exactly what JPMorgan did in this memo.
Ah, right.
They ran the raw arithmetic, and the cold reality is just sobering. The world consumes approximately 100 million barrels of oil every single day.
Every single day.
Yes, and the Strait of Hormuz handles roughly 20% of that global flow.
Wait, hold on. Let me work through that math. The world needs 100 million barrels a day. The closed strait chunked off 20 million barrels of that daily need.
Correct.
So if global superpowers just coordinated the largest emergency release in human history at 400 million barrels.
Keep going.
400 divided by 20, that means that record-breaking, historic release only bought the world exactly 20 days of replacement flow.
20 days. That is the mathematical ceiling.
Oh my God.
Right. The global community drained the ultimate strategic safety net to plug a hole in the supply chain that lasted for months. And it only provided 20 days of true cover.
That is terrifying.
It is. And this brings us to the most precise analytical tool in the memo, which is JPMorgan's reserve map.
Okay, I saw this in the memo.
Yeah, it tracks exactly who has a safety net left and who is operating without a net.
And looking at this map, I mean, the disparity is genuinely terrifying.
It's stark.
You have Japan and South Korea sitting on over 200 days of strategic petroleum reserve.
Right, they're fine.
China has about 120 days, which is roughly on par with Europe and Taiwan. But then you look at the frontier sovereigns.
They're developing nations.
Yeah, places like Ghana, Sri Lanka, Pakistan, Bangladesh, they do not have 200-day buffers. They barely have any strategic reserves at all.
And that disparity, that exposes the crux of the illusion. The market is confusing a flow variable with a stock variable.
Right.
The price of oil is a flow. It updates every day on a ticker. It went from 112 down to 95.
Which people see and cheer.
Exactly. But national reserves are a stock variable. They are finite because frontier nations do not have massive physical barrels of oil stored underground like Japan does.
They just don't have the tanks.
Right. So they had to survive months of purchasing energy at $112 a barrel on the open market. To keep their electrical grids running, they had to burn through their own sovereign financial buffers.
You know, if you're hearing the terms flow versus stock and thinking it sounds a bit like an academic textbook, think of it in terms of your own personal bank account.
That's a great way to look at it.
Imagine you suddenly have to take a massive pay cut at work. That is your flow being disrupted.
Right.
To survive and keep paying your rent, you have to drain your entire life savings. That is your stock.
Exactly.
Now, let's say 6 months later, you finally get your old salary back. Your flow is fixed.
You're happy?
You are out celebrating. But your life savings, that money you burned through to survive the last 6 months,
It's gone.
it is permanently gone. You are completely exposed if your car breaks down tomorrow.
Completely exposed.
Translating that back to the global stage, even though the flow of oil dropped back down to $95, the national savings these countries burned through to survive the spike are permanently gone.
What's fascinating here is that the global market is treating this situation as if the life savings automatically regenerated just because the salary went back to normal.
Like it just magically reappeared.
Right. JPMorgan states explicitly that strategic reserves are not designed to eliminate energy shocks. They're only designed to provide temporary flexibility.
A bridge.
Yes,
Yeah.
a bridge. The relief from the $95 oil price is very real. It means these vulnerable countries aren't bleeding cash quite as fast today as they were yesterday. But the assumption that their national balance sheets have magically reset to normal, that is the illusion. The structural systemic damage is already done.
So this leads to a massive contradiction. If these frontier nations have entirely burned through their financial life savings just to keep the lights on, you would expect their stock markets to be in absolute freefall.
You would.
But they aren't. In fact, the emerging markets index, the MSCI EM, just surged by an incredible 6.9% in a single week.
Which is huge.
A near 7% return in 5 days makes it look like these economies are absolutely booming.
And this is what the memo diagnoses as the wrong proxy problem.
Okay.
When a casual investor sees a 6.9% surge in the MSCI EM index, they naturally assume emerging economies across the board are healthy and recovering.
That makes sense.
But you have to lift the hood and look at what actually comprises that index today. It is no longer a broad reflection of global developing economies.
No, not at all.
It is being violently heavily skewed by one specific narrative,
The AI boom.
the AI boom.
The data on this is wild. The memo notes that South Korea's KOSPI index jumped 13% in 1 week.
Right.
And that wasn't because their broader manufacturing sector, like, hyper-accelerated. It was purely driven by global demand for memory chips.
Exactly.
And then there is Taiwan. Merrill Lynch points out that Taiwan is now the 4th largest country weight in the MSCI All-Country World Index.
Which is essentially a snapshot of the entire planet's stock markets.
Right.
Consider the physical reality of that metric.
Okay, picture the entire physical economy of France.
The luxury goods, aerospace,
Right, agriculture. Then add the entire economy of Canada.
massive oil production, banking, lumber.
Exactly. The global stock market is currently weighting the island of Taiwan higher than both of those massive nations combined.
It's hard to even wrap your head around.
Purely because they manufacture the hardware that powers artificial intelligence. Here's where it gets really interesting. The Emerging Markets Index isn't a picture of global recovery. It's essentially just 3 AI hardware companies wearing a trench coat,
I love that.
masking a world of financial pain. We have the Magnificent Seven tech stocks in the U.S. posting 61% earnings growth in the first quarter of 2026,
Which is absurd.
compared to a meager 16% for the other 493 companies in the S&P 500. The AI trade is so overwhelmingly massive that it's blinding everyone to the underlying decay.
If we connect this to the bigger picture, the divergence between the illusion and reality becomes just alarming.
Yeah.
If you want to see the true health of frontier nations, you cannot look at an equity index bloated by semiconductors. You have to look at the debt markets.
Okay, the EMBI.
Right. The memo contrasts the MSCI EM equity index with the JPM EMBI index. The EMBI is essentially a scorecard showing how easily these developing nations can pay back the sovereign debt they owe in U.S. dollars.
Got it.
While the equity index surged 6.9%, the actual debt index, where the reality of their financial health, only returned 0.5%.
That is a staggering gap. 7% versus like 0.5%.
The equity index is South Korea's memory chips. The credit index is Ghana's empty reserve position. They exist in completely different financial universes.
Wow.
And the stock market is aggressively pricing in all the explosive upside of the AI earnings cycle.
Yeah.
But it is willfully ignoring a massive, looming vulnerability that is happening right out in the open at the U.S.-China summit.
Well, I want to push back on that a bit, though, because the memo treats this summit as a major risk factor, and that just seems counterintuitive to me.
How so?
I look at the U.S.-China summit and I see bilateral trade sitting at $582 billion annually.
Yeah.
Two global superpowers sitting at a table talking face-to-face.
Right.
Usually the market looks at diplomacy and assumes stability. Thick and sticky, capital flows, mutually beneficial relations. How is a peace summit a poison pill for the market?
Well, the market is indeed celebrating the summit as a de-escalation, which is partly why we see this global rally.
Right.
The flaw in that logic is looking at the agenda. Buried within those diplomatic talks are negotiations for incredibly strict semiconductor hardware restrictions.
Oh.
Yeah. The market is pricing in a massive geopolitical reconciliation premium, while completely ignoring that the regulations being discussed are aimed directly at throttling the exact hardware that is holding the market up.
Wait, you mean the same hardware driving the entire AI boom?
Yes. The Philadelphia Semiconductor Index is currently trading 60% above its 200-day moving average.
That's massive.
Semiconductors now make up 17% of the entire S&P 500 market capitalization, which is up from just 5% back when ChatGPT first launched.
Okay, so spell out the mechanism there. Why does a restriction discussed in a boardroom crash the market?
Because stock valuations are based on future expectations. Microsoft just raised its 2026 capital expenditure guidance to $190 billion to build AI infrastructure.
Right, they're building data centers everywhere.
But that assumes an unhindered, infinite supply of chips and global sales. If the U.S. and China agree to restrict the physical export of high-end chips, or if they sever the complex supply chains required to build them,
Then what happens?
the actual physical sales volume of those companies will plummet. You cannot have explosive AI earnings growth if you legally cannot ship the hardware.
Oh, man.
The market is currently trying to price in the piece of the summit A&D, the unhindered growth of AI at the same time.
Yeah.
You cannot price both of those realities
Yeah.
at full value simultaneously.
It's the big pockets misdirection again.
Exactly.
Look at the diplomatic handshakes on the stage, but don't look at the semiconductor export bans being slipped into the briefcase.
Spot on.
So we've established that the oil buffer is completely gone, and the stock market indices are painting a fake picture of health by riding the AI wave.
Right.
So what actually happens to these vulnerable frontier countries, the ones operating without a net, when global central banks start turning the screws?
That's the real issue.
Like, if WTI crude oil is back down to $95, shouldn't their daily import costs be lower? Why are they still in the danger zone?
Because the bill has already been rendered.
What do you mean?
The relief trade in the stock market is treating an expensive invoice as if it were canceled. It was not canceled. It simply arrived in the mail.
Okay.
Look at the International Monetary Fund's current monitoring of Ghana, as detailed in the dispatch. The IMF is forcing the Bank of Ghana to report their foreign exchange auction results, their swap lines, and their encumbered asset data on a weekly basis.
Weekly. Let's define some of those terms, because asking a sovereign central bank to open its books every single week is definitely not standard procedure.
Oh, it's highly unusual.
Encumbered assets are basically funds a country holds that have already been promised as collateral for another loan, right? Like they aren't free to spend.
Exactly.
And swap lines are essentially emergency currency exchanges between central banks. It's like a nation borrowing cash just to make payroll.
That's a good way to put it.
For the IMF to demand to see that data weekly, I mean, that is the equivalent of putting a national economy in the intensive care unit.
It is absolute life support. It proves that their available reserve buffer is the binding constraint on their entire stability.
Wow.
When oil drops to $95, their forward-looking fuel costs go down, yes. But the IMF isn't asking for weekly reports because they are worried about tomorrow's oil price.
They're looking at the damage already done.
Right. They are asking because the stock of reserves that Ghana burned through over the last few months to survive the initial spike is entirely gone.
And it isn't just small frontier nations feeling this structural pain. The memo points out that India is facing a massive fiscal reckoning, right?
Oh, yeah. The dispatch tracks India's fiscal arithmetic really closely. The IMF's recent economic assessment of India was built on pre-war energy assumptions.
Okay.
They modeled the country's economic growth, assuming oil would stay relatively stable.
Which didn't happen.
Those assumptions were entirely invalidated the moment the Strait of Hormuz closed. India's deeply embedded subsidy frameworks for its citizens that simply never modeled oil at $112 a barrel. The fiscal capacity they consumed surviving that spike is just gone.
Here's where it gets really interesting, because these countries are getting hit from an entirely different angle at the exact same time.
The double whammy.
It's a brutal double whammy involving the Bank of Japan, the European Central Bank, and something called the carry trade.
Right.
Can you walk us through the mechanics of the carry trade and why a shift in Japan's currency is suddenly a nightmare for emerging markets?
Sure. So to understand the squeeze, we have to look at how these developing nations get their funding. For a long time, institutional investors have utilized the carry trade.
Okay.
Because Japan kept its interest rates practically at zero for years, an investor could borrow money in Japanese yen very cheaply.
Almost free money.
Exactly.
Yeah.
They take that virtually free yen and they invest it in high-yield sovereign debt in emerging markets, places like Pakistan, Egypt, or Kenya, which might pay out 7 or 8% interest.
So they borrow at 0 and earn 8.
The investor pockets the difference. And that mechanism provides a massive, continuous flow of liquidity to these frontier nations.
I want to make sure I have this clear. It's like getting a credit card in the mail with a 0% introductory interest rate.
Yeah, exactly.
You take a cash advance on that 0% card, and you use the cash to buy a high-yield corporate bond paying 10%. You are making free money on the spread as long as the credit card company keeps the interest rate at 0.
That is the perfect analogy. But imagine what happens to your personal finances if that credit card company suddenly hikes your interest rate to 8%, while your money is locked up in a bond you can't easily sell.
You're trapped.
That is exactly what is happening globally right now. The Bank of Japan is shifting its policy.
Right.
The yen recently spiked 2%, with the USD JPY rate settling at 156.68. Goldman Sachs is reporting severe suspicions that the Bank of Japan is actively intervening in the markets to prop up the yen and make it more expensive.
And the memo notes the European Central Bank is doing something similar, right? Goldman confirmed the ECB is locking in a 25 basis point rate hike for June.
Yeah, so the era of cheap funding is violently slamming shut.
Just as they need it most.
Exactly. The virtually free money that these vulnerable countries rely on to roll over their existing debt is drying up at the exact moment their national savings accounts are sitting at 0 because of the energy shock.
That is brutal.
The structural stress from expensive oil consumed their fiscal capacity, and now the funding mechanism that might have bailed them out is tightening.
Which brings us to the actual investment strategy takeaways from Sovereign Dispatcher.
Right. How do you trade this?
Yeah. How do you position a portfolio when the global economy is in this bizarre state? The memo explicitly says to maintain positions in Latin American commodity exporters.
Which makes sense.
The logic there makes total sense. If you export oil, a stable $95 oil price is still highly profitable, and your fiscal break-in, the price you need to balance your national budget, is much lower, you are fine.
You're actually doing great.
But the memo issues a massive warning to avoid frontier Asia, places like Sri Lanka, Pakistan, and the Maldives.
Right, you avoid them because their strategic reserve cover is practically non-existent.
Oh.
And they are fully exposed to the tightening of that carry trade we just discussed.
Because they need that cheap funding.
Exactly.
Yeah.
Furthermore, the memo strongly advises preferring a hard currency like the US dollar over local emerging market currencies.
Because the U.S. inflation data is keeping American interest rates high.
Yes.
The U.S. Consumer Price Index just came in hot at 3.7%, up from 3.3. That means inflation is sticky, so the Federal Reserve just cannot cut rates.
They're pinned.
Merrill Lynch expects the Fed funds rate to sit at an elevated 3.63% straight through the end of 2026.
Which is high.
So if the U.S., Europe, and Japan are all tightening their belts or holding rates high, emerging market local currencies are going to get absolutely crushed as capital flees the safety of the dollar.
Exactly.
So what does this all mean? For you listening right now, why does a deep dive into an institutional strategy memo from May 2026 matter to your life?
It's a fair question.
It fundamentally changes how you should consume financial news. Oh, 100%.
When you open your app tomorrow morning and see the stock index booming or a headline celebrating that gas prices are finally coming down, realize that a positive surface metric does not mean the underlying system is healthy.
Right.
You have to ask yourself, what is driving those numbers? Are we seeing a broad, stable global recovery, or are we looking at 3 AI hardware companies masking a fractured, vulnerable global debt market?
You know, there is a brilliant quote in the memo from the legendary investor Howard Marks that perfectly encapsulates this entire illusion.
Oh, I love Howard Marks. What does he say?
He writes, "The most dangerous position is not the one that is priced wrong, but the one that is priced against the wrong question."
The wrong question. That is so deeply profound.
Right now, the entire street, all the financial talking heads on television, they're all asking, is the Strait of Hormuz going to reopen?
Right.
And if you were a daily energy trader trying to make a quick buck on oil futures, that might be the right question.
Sure. But if you care about the actual structural long-term health of the global economy, it is entirely the wrong question.
So what's the right question?
The real question you should be asking is, have the national balance sheets recovered from the trauma of the shock?
And based on everything we've talked about.
And as the data in this dispatch proves, the answer is unambiguously no. The relief trade happening in the markets right now is treating an enormous invoice as if it were canceled.
But it wasn't canceled.
It was not canceled. The bill has already been rendered, and eventually the debt comes due.
It all comes back to misdirection.
Yeah.
The market is cheering for the pickpocket sudden movements, the dropping oil prices, the AI stock boom, the summit handshakes. But underneath it all, the global savings account has already been emptied.
It's totally drained.
And that leaves us with one final, deeply unsettling thought to walk away with today. We established the math earlier, right? The largest emergency strategic reserve release in human history.
400 million barrels of oil.
Coordinated across 32 allied countries. And it only bought the world exactly 20 days of mathematical buffer against a single choke point closure.
A mere 20 days.
So ask yourself this. What exactly happens to the global economy when the next geopolitical choke point closes, the flow of oil stops again, and those emergency global reserves are already sitting empty?
Yeah.
Think about that the next time you see the market hit a record high. Thank you so much for joining us on this deep dive. We'll catch you next time.